In this video, we're going to look at examples from Chapter 11 for Principles of Accounting 2. So in Chapter 11, we looked at analysis of divisions using ROI, return on investment, utilizing the DuPont model calculations of return on investment, which is profit margin times the asset turnover ratio, and then also looking at residual income. We talked about transfer pricing in Chapter 11 and service department charges. So we're going to go through an example of each one of those. In this first example, we're going to be looking at return on investment for division and then the return on investment for an investment opportunity and how taking that investment opportunity changes the division's results. So our first question asks us to calculate what was last year's profit margin. So if you remember from the Chapter 11 reading and lecture, the profit margin is calculated by dividing net operating income by sales. So we will take our net operating income from our results, $200,000, and divide that by our sales of $1 million. And that gives us a profit margin of 20%. The next calculation we do is the asset turnover ratio. So again, if you remember from the chapter and the lecture, the calculation for asset turnover ratio is sales divided by operating assets. So we take our sales of 1 million and divide by our average operating assets of $625,000. We get a ratio of 1.6. That tells us that for every dollar this company invests in assets, it is able to generate $1.6 in sales. Our return on investment is the profit margin times the asset turnover ratio. Take our profit margin of 20% times our asset turnover ratio of 1.6. That gives us a return on investment, or ROI, of 32%. That is well above our minimum required rate of return of 15%. So this division is performing above our minimum required rate. Questions 4 through 6 ask about this $120,000 investment opportunity that the business has an opportunity to take on. We're given the additional sales. The cost of the opportunity is $120,000. Additional sales generated from this opportunity are $200,000. The only thing that we're missing is what the operating income is from this investment opportunity, or what it adds to our operating income as a division. In order to calculate that, we're going to use a contribution margin ratio analysis. So we have our contribution margin ratio. So if you remember, the difference between the contribution margin ratio and sales is that this is what is left after variable costs. So if we take our $200,000 in sales times the contribution margin ratio, that gives us our contribution margin. And contribution margin minus fixed expenses equals operating income. So see how we bring things back from previous chapters. So in order to calculate the profit margin, we're going to take our net operating income of $30,000 divided by 200,000 in sales. And we get a profit margin of 15%. The asset turnover is sales divided by average operating assets. So we have sales of 200,000 for this investment opportunity, and the average operating asset is the cost of the investment opportunity, or $120,000. That gives us a turnover of 1.67. The ROI, we take the profit margin times the asset turnover ratio, and we get a return on investment of 25%, which is higher than our minimum required rate of return of 15%. So this investment opportunity has a higher rate of return than our minimum. The next three questions ask, if we take on this investment opportunity and we have similar results as our last year income statement, what will our profit margin be this year? So looking at last year's results and adding the investment results to them, what is that going to change about our overall profit margin from this year to last year? So in order to add the investment, we have to add those two things together. So for profit margin, that's net operating income divided by sales. So we need the net operating income from the investment plus the net operating income from last year's results. Then when we divide by sales, that needs to be the sales from the investment plus the sales from last year. So we have a profit margin of 19%. Asset turnover ratio is total sales divided by the total average assets. So we need sales of 200,000 from the investment plus sales of 1 million from last year's results divided by our average investment of 625,000 plus the 120,000 cost of the new investment. And now if we take our turnover times our profit margin, we get a return on investment of 31%. Question 10 says, if we earn a bonus only on our ability to exceed ROI from the previous year, would we take on this opportunity? So if our return on investment was 32% last year, and taking on this investment makes our return on investment drop 1 percentage point, the chief executive officer would not be inclined to take on that investment because it is lowering the thing that determines their bonus. This is one of the reasons that we continue to come back to that we should not evaluate bonuses based on one measurement or one metric, because the CEO in this case would turn down this investment opportunity. So the other measurement we can do is residual income. If you remember from the lecture and from the textbook reading, residual income is operating income minus the average investments times our minimum required rate of return. So to calculate our residual income last year, we're going to take our operating income of 200,000 minus the average assets, 625,000, times the minimum rate of return of 15%. That gives us a residual income of $106,250. For the residual income of the opportunity, we will take the income of 30,000 for the opportunity minus the investment of 120,000 times the minimum rate of return of 15%, giving us residual income of 12,000. Number 13 says, if the company pursues this investment opportunity and otherwise performs the same as last year, what residual income will it earn this year? Well, here we have, if our residual income and the investment and none of our numbers change, then our new residual income for the year taking on the investment is just simply these two added together. And if we calculated the full residual income, we would get the same result as $118,250. Question 14 says, if bonuses are dependent on residual income, would the CEO take the investment? Yes, she absolutely would. She or he absolutely would. that is an increase of $12,000 from the investment, and they absolutely would say yes to the investment. Number 15 says, assume that contribution margin ratio of the investment opportunity was 50% instead of 60%. Then would we pursue the investment opportunity? Well, because we use calculations in Excel, we can just, instead of redoing all of the calculations at a 50% contribution margin ratio, I can just change this to 50%, and it's going to redo everything for me. So then you see that the ROI has dropped from 25% to 8%. That no longer meets our minimum required rate of return. So we're going to reject it just because of that. Not just because it drops our required rate of return, but because it doesn't meet our minimum of 15%. We also see that now, instead of a 12,000 positive residual income from that investment, we have negative 8,000 residual income from that investment. So that makes a huge difference in whether we would accept that investment or not.